Every month you pay your bills and wonder where your money went. This video shows you exactly where it is going and how much more you are paying now than 5 years ago. These are not forgotten subscriptions or impulse purchases. These are the unavoidable costs of modern American life: housing, transportation, food, insurance, and debt, expenses that have quietly surged while wages barely moved. We are counting down 10 bills ranked from surprising to devastating, with the real numbers behind each one. Starting at number 10, the one bill almost no American can live without. In the 10th place, internet and phone bills have quietly become a major drain on household budgets. The average American now spends over $200 every month just to stay connected, an expense that has jumped sharply since 2020. Carriers like Verizon, AT&T, and Comcast have all announced repeated price hikes over the last 4 years, with some residential plans rising more than 20%. For many, there is little choice. In nearly 4 out of 10 zip codes, only one broadband provider is available, which gives companies the power to set rates with minimal competition. What was once a modest utility has turned into a mandatory, ever-growing bill that is nearly impossible to avoid. Number 9, streaming and subscription services have quietly morphed from a cheap cable replacement into a real monthly burden. The average household now pays for at least 4 platforms: Netflix, Disney+, Hulu, and Max, each one ratcheting up prices every year. What once cost $15 to $20 now routinely tops $60 or even $80 a month, especially for families who want ad-free tiers or premium bundles. Password sharing crackdowns have ended the era of splitting costs, forcing more people to open their own accounts. The shift isn't just about entertainment, it's another bill that feels impossible to cut, even as wages barely budge. Streaming has become a digital utility, draining wallets one auto-renew at a time. In 8th place, home and renters insurance has quietly become a financial flashpoint for millions of households. Premiums have jumped more than 20% nationwide since 2021, adding a new layer of strain to the basic cost of shelter. In states hit hardest by climate risk like Florida, annual bills can now top $6,000, with some homeowners facing non-renewals or forced to buy coverage from last resort state pools. Insurers are pulling out of entire markets in both Florida and California, citing wildfire and hurricane losses that make coverage harder to find and far more expensive. Even renters aren't spared. Landlords often pass these higher costs along through rent hikes or mandatory policy requirements. What used to be a manageable monthly line item now compounds the broader housing squeeze, forcing families to weigh their need for protection against the reality of rising rent and stagnant paychecks. As the cost of simply keeping a roof over your head climbs, insurance is no longer just a safety net, it's another bill that can tip the balance for already stretched budgets. Number 7. Utilities, including electricity, gas, and water, have become a flashpoint for financial stress in households across the country. More than 14 million homes are now behind on their utility bills, with the average overdue balance reaching $790 as 2025 approaches. These aren't bills you can simply skip or cancel. Lights, heat, and running water are non-negotiable. Yet utility rates have surged faster than the overall cost of living, outpacing the consumer price index year after year. Much of the increase can be traced to aging infrastructure and the rising cost of fuel, with utility companies passing those expenses directly onto customers. Municipal water rates have quietly climbed as cities struggle to fund repairs and upgrades, while electricity and gas bills spike during heat waves and cold snaps. The result is a growing wave of shutoff notices and mounting arrears, forcing millions to juggle payment plans just to keep the basics running. For families already stretched thin, these bills pile on top of everything else, turning everyday survival into a monthly scramble. Number 6, groceries have quietly undergone a permanent reset, turning every trip to the store into a reminder of how far a paycheck no longer stretches. Since January 2020, food prices have jumped by 25% overall, with some staples soaring far higher. Eggs, for example, have spiked by a staggering 95%, while beef and milk have each climbed more than 30%. These aren't luxury items, they're the core of every family's table, and skipping them isn't an option. The U.S. Department of Agriculture's monthly food budget for a family of four has surged from $654 to $976, an increase of $322 every single month. That's nearly $5,000 extra dollars a year just to maintain the same meals. Even as headline inflation slows, food costs remain stubbornly high, showing no sign of returning to pre-pandemic levels. For millions, this means more credit card swipes at the checkout and fewer dollars left for other essentials. When groceries become a source of anxiety, it's not about splurging, it's about survival. Number 5, credit card interest has turned into a relentless monthly drain for millions of households. As the cost of basics like groceries and utilities shot up, more families leaned on plastic just to keep up. But what was once a short-term fix has morphed into a long-term trap, thanks to a surge in average annual percentage rates. Today, the typical credit card carries an annual percentage rate above 22%, up from about 17% just a few years ago. That increase is not just a number on a statement, it is a direct hit to the wallet every single month. Americans now owe over $1.2 trillion on their credit cards, an all-time high. For someone carrying a $5,000 balance, that 22% rate means more than $1,100 a year in interest alone, even if they never swipe again. And with minimum payments stretched over years, the cost of borrowing compounds, making it even harder to dig out. The Federal Reserve's rate hikes have passed straight through to consumers, turning every unpaid balance into a profit engine for banks. As other bills climb, more people are forced to finance daily life at punishing rates, stacking pure interest charges on top of already inflated essentials. Credit card interest is not just another bill, it is the multiplying force that makes every other financial pressure feel heavier. Number 4, car insurance has become an unavoidable financial punch for anyone who needs to drive. Since 2020, the average annual premium has soared by more than 50%, pushing the national average past $2,150 a year. That is not an optional luxury or a nice to have. It is a legal requirement in almost every state, and the bill comes due before you even think about a car payment or filling the tank. For millions, this jump is not just a statistic. It is a real monthly squeeze that eats into budgets already stretched by higher prices everywhere else. In some states, the situation is even more extreme. Drivers in Florida now face average premiums close to $2,850, while Michigan and Louisiana are not far behind, each hovering above $2,600. The reasons are a toxic mix: rampant insurance fraud in Florida, high litigation costs in Michigan, and a steady stream of hurricane claims in Louisiana. Even deductibles have crept higher, meaning drivers pay more out of pocket before coverage kicks in. The relentless rise is not just about more expensive cars or risky drivers. It is a system-wide shift that leaves everyone paying more, no matter how clean their record. As premiums climb and wages barely budge, car insurance has quietly become one of the most punishing bills in the American household, making it harder for families to afford the basic freedom of getting to work or school. Coming in at number 3, car payments have become a monthly shock for households across the country. The price of both new and used vehicles soared after 2020, driven by a global semiconductor shortage that choked supply and sent dealers scrambling to mark up whatever inventory they could get. According to the Manheim and Kelly Blue Book price indices, the average price for a new car jumped more than 30% in just 4 years, while used cars saw similar spikes. As a result, the typical monthly payment for a new car now tops $700, with used car buyers facing bills over $500, a record high on both fronts. These aren't luxury purchases or high-end leases. These are average payments for everyday sedans, crossovers, and trucks. The sticker shock is so severe that auto loans now regularly stretch 72 months or longer, locking families into 6-year commitments just to afford basic transportation. Longer terms might mean a lower monthly bill, but they also trap drivers in cycles of negative equity, where the car is worth less than the loan for years on end. With wages barely moving, these inflated payments eat up a growing share of each paycheck, especially for workers who have no choice but to drive to work, school, or childcare. When combined with the skyrocketing cost of car insurance, the total burden of simply owning and operating a vehicle now exceeds $1,200 a month for many families. This isn't about splurging on a new ride, it's about financing the bare minimum needed to participate in daily life. As car payments climb ever higher, they squeeze every other part of the budget, leaving less room for groceries, utilities, or savings. The result is a relentless financial pressure that turns basic mobility into one of the most punishing fixed costs in the American household. Number 2, childcare has become a defining bill for families, shaping not just budgets, but life decisions. The national average cost for full-time care now tops $15,000 a year, a figure that has climbed by 7.7% in just the last 12 months. In cities like San Francisco and Washington, D.C., that number can easily double. Annual bills of $30,000 a year or more are no longer outliers, but the going rate for a single child under 5. For many parents, this is not a negotiable expense. It is the price of being able to work at all, yet the system itself is buckling. Since 2020, thousands of childcare centers have closed their doors, driven out by pandemic disruptions and chronic labor shortages. The result is a crisis of capacity. Wait lists now stretch for months, sometimes years, and parents are forced to make impossible trade-offs, cut back hours, leave jobs, or spend more than a third of their take-home pay just to secure a spot. Federal and state subsidies exist, but they rarely cover the full cost, leaving a gap that working families must close on their own. The pressure is relentless. For a mother in D.C. earning $60,000 a year, after taxes and childcare, barely half her income remains. In two-parent households, the math often leads one partner, usually the lower earner, to step back from the workforce entirely, sacrificing future earnings and retirement security. The ripple effects are massive: lost productivity, stalled careers, and a shrinking labor force that feeds back into the broader economy. Childcare costs have reached a tipping point, dictating whether families can afford to work, where they live, and how much they can save. As other bills climb, this is the expense that determines if parents can even participate in the economy, making it one of the most punishing and least avoidable bills in American life. And finally, in first place, rent stands as the defining expense that shapes every other part of the budget. Over the past 5 years, the cost of renting a home in the United States has surged by 38%, while household incomes have climbed just 28%. That gap is not a rounding error. It is the reason so many families find themselves squeezed, no matter how carefully they budget. According to Harvard's Joint Center on Housing Studies, nearly 43.5 million households now spend more than 30% of their income on rent. For 21.6 million, the burden is even heavier. Over half their take-home pay goes straight to the landlord every month. This is not a coastal or big city phenomenon. Sunbelt cities have seen some of the sharpest spikes. Miami rents climbed nearly 40% since 2019, with Tampa close behind at 39.3%. Phoenix rents jumped 37%, Atlanta 33.9%. Even in smaller metros and suburbs, the story is much the same. Demand outpaces supply, and wages simply cannot keep up. For a household earning $75,000, only about 1 in 5 available rentals is considered affordable under the standard 30% rule. The rest are simply out of reach, forcing families to make impossible choices, longer commutes, smaller spaces, or cutting essentials just to keep a roof overhead. The pressure is most acute for those already on the edge. Black and Hispanic renters, single parents, and families with young children face the highest rates of severe cost burden. In major cities, vacancy rates have hovered near historic lows, and new construction has not been enough to stem the tide. Regulatory costs, higher interest rates, and labor shortages have all pushed rents higher, while federal assistance and local voucher programs cover only a fraction of the need. When rent consumes 40 or even 50% of income, every other bill, utilities, groceries, insurance, becomes a crisis waiting to happen. The cost of shelter is the multiplier that makes every other expense harder to manage. For millions, the math no longer works. Pay the rent or pay the rest. That is why rent is not just another line item. It is the bill that dictates financial survival, the force that drives the entire cost of living crisis. As long as housing eats the first and biggest bite out of every paycheck, the pressure on American households will only keep building. Across all 10 essential bills, one truth stands out. The cost of basic survival in America has outpaced paychecks. Wages barely moved, but rent, childcare, and core expenses soared, leaving millions squeezed by forces beyond their control. This is not lifestyle inflation. It is the new reality of making ends meet. When necessities become luxuries, financial stress is not a personal failing. It is a nationwide reckoning. Share your experience with these rising bills in the comments below.